With us today from the Milken Conference out in Los Angeles. It's good to see you again. Welcome back.
Hey, great to be here, Scott.
You know, I always feel like when you're with us, we're either in the storm or we're trying to figure out how long it's going to be until we see the sun start shining again. And I mentioned in the intro to you this call you made back in October when you were with us about what you expected to happen to especially higher valuation tech within the NASDAQ. Let's revisit that, and we can talk on the other side.
If the NASDAQ were to correct, if the growth multiples were to correct to January 2020 levels, pre-COVID, in January 20, nobody thought that multiples were too low. We'd have about a 30% correction in the NASDAQ. So I think when you're looking at the distribution of probabilities, whether you're playing from home or whether you're doing this for a living, you need to leave open the possibility that as rates begin to move up, as the world normalizes, multiples are going to normalize.
I'm not sure. I mean, the shirt looks the same, although it looks like a hoodie this time. So some things change and some things stay the same. So we're down 22.5%, 22.5% from NASDAQ highs. You said 30. I mean, you know, that's close enough. Are we done?
Well, I'll tell you, I like my beard game better from last year, too. It's hard to believe that that was only October 19th that we were here at Milken and that we had that conversation. But, Scott, 22% in the NASDAQ doesn't really tell the story. The internals of the NASDAQ, the growth stocks, as you well know, are down 50 to 80%. And so we've now retraced below that 5-year average that I referenced in October. Certainly when we were talking in October, I wasn't anticipating a war in Ukraine. We weren't anticipating the concerns around hyperinflation, energy inflation, food costs that we've now seen. So we've overshot the averages. And now I think is the time that whether you're playing from home or whether you're a professional investor, you have to find opportunities to buy. You know, it's notable that Berkshire, after having $7 billion in net sales in 2020 and 2021, has deployed over $50 billion in the first quarter of this year. They don't know, and I don't know, when the tradable bottom is in. But we do know that we're closer to it today than we were last October. And I think if you're an investor investing over a 1, 2, 3-year time horizon, find your best ideas and put money to work.
Well, you have to find opportunities to buy. Those are your direct words just now, because it's such a stark contrast to what Paul Tudor Jones told our network today. Quote, it's hard to find a worse environment than where we are right now for financial assets. You don't want to own stocks or bonds. What do you make of that?
Well, I'm a huge fan of Paul. I watched him this morning. I encourage everybody to go to Robinhood.org and donate. But, you know, if you think about the 4 things that Paul talked about, interest rates, the direction of inflation, the ongoing war, and the increasing concerns about slowing global growth, those are well known, right? So at some level, they're priced into the market. Do we have more to go? Paul doesn't know. I don't know. But it's more asymmetric to the upside today. I just listened to Jim and Steph talk about, you know, us being data dependent and looking at that CPI print on May 11th. I think inflation is already rolled over. I think there's already a tremendous amount of demand destruction occurring in the world. The Fed and what the Fed does in terms of rates over the course of the next 6 months will determine the path of multiples. I think it's at least even odds that that direction will be up from here because so much has come out of the market from a growth multiple perspective.